This chart tracks a deep paradox in modern macroeconomics. On the left, institutional financial metrics like the S&P 500 and global debt volumes trend steadily upward. On the right, underlying biophysical and social metrics, aquifer levels, ecological stability, and social equality show severe, accelerating decay. A society can appear formally solvent on a balance sheet, while its underlying life support systems collapse. The financial accounting masks the actual depletion of the real-world resources required to sustain it. Standard neoclassical economics treats this disconnect as an externality. It assumes finance is a neutral subsystem of exchange, a technical instrument laid cleanly over the real economy. From a biological systems perspective, finance operates differently. It functions as a civilizational grammar. It operates through what biologists term structural coupling. The rules of financial accounting dictate what a society perceives as valuable, what futures it chooses to fund, and what forms of life it will abandon to hit a quarterly target. This grammar shapes the domains of action a society conserves. By defining the parameters of creditworthiness and risk, the financial system influences which social and ecological possibilities remain open. We are living through an ontological inversion. Look at this schematic. Historically, money operated as a tool nested inside the larger, bounded system of human life and ecology. Over time, that relationship inverted. The parameters of money became the strict container, and life was squeezed inside it. Instead of money serving the life processes of a community, human labor, healthcare, housing, and ecological systems are forcibly reorganized to feed the abstract accumulation of money claims. To understand how this pathology took hold, we must trace the specific chronological mechanisms where money first detached from physical reality. Tracing money back to its anthropological origins reveals the structural shifts that transformed a system of social coordination into an autonomous system of extraction. This graphic maps the historical drift of money, moving from ancient relational networks to modern digital protocols. Zooming in on the earliest stage, money did not evolve from isolated individuals swapping commodities in a barter system. The icons here, reciprocity, trust, and social memory, represent money's actual origin. It began as a ledger of mutual obligation, a way for communities to record tribute, redistributions, and shared responsibilities. These early ledgers were strictly constrained by the physical limits of the community. A debt could not exceed the harvest or the available labor. The ledger required human context to function. The creditor knew the debtor, and obligations were adjusted based on illness, crop failure, or communal need. Money emerged as a social technology designed to bind a community together, rather than a mathematical tool designed to abstract them. Moving to the center timeline, we hit the transition from relational obligation to formalized institutional debt contracts. Here, obligations become quantified, legally enforceable, and subjected to compound interest. This introduces the creditor's illusion, the belief that enforceable financial claims can grow indefinitely without consequence. This graph tracks a compounding financial claim. The line representing debt rises exponentially, accelerating without limit. We add a logistical S-curve representing biophysical capacity, the rate crops grow and ecosystems regenerate. The gap widens rapidly. This is a temporal asymmetry. To maintain the required debt service, the living system must cannibalize itself. Forests are clear-cut, public infrastructure is defunded, and wages are suppressed. Compound interest enforces a mathematical trajectory that guarantees eventual systemic collapse if left unchecked. Panning to the final stage, we reach the era of autonomous claim power. Modern financial abstraction takes the debt contract and hyper-quantifies it. Capital is tokenized and instantly transferable. Securitized derivatives and algorithmic risk scoring strip away remaining human context. The system cannot perceive an exhausted caregiver, it only registers a disruption to the yield. Capital detaches from the physical consequences of its extraction. Shadow banking and offshore secrecy cement this detachment, allowing wealth to relocate and avoid accountability. This detached capital draws immense value from the civil commons, public infrastructure, educated labor, and legal order, without contributing resources back. This architecture extracts infinite yield while escaping local reciprocity. It breaks the baseline rules of biological survival, creating a self-referential loop that destroys its own host. Sociologist Johann Galtung defined a concept that describes this condition perfectly: structural violence. Enforcing artificial scarcity, mass austerity, and debt peonage to satisfy an abstract ledger is systemic harm. It damages bodies, shortens lives, and destabilizes societies, while presenting itself as a mathematically necessary market outcome. Repairing this requires a new theoretical architecture. This node graph outlines a framework for life-coherent financing. The outermost boundary condition is strict. Finance must remain coupled to life capacity. Economic historian Michael Hudson points out that ancient agrarian societies recognized the danger of compounding debt. They regularly instituted widespread debt cancellations, known as jubilees. A jubilee was not a charity program. It was a mandatory biological immune response designed to reset the temporal asymmetry of interest before it destroyed the productive base of the polity. Modern financial crises are often met with institutional bailouts that protect the abstract claims of the creditors, while forcing the real-world society into liquidation to cover the losses. A functioning civilization must possess the mechanism to sever abstract financial claims in order to preserve its physical and productive base. Philosopher John McMurtry formalized this into the life value test, establishing a new operating metric for economic policy. The principle states, no financial claim is legitimate beyond the life capacity required to honor it. Applying this test shifts the metric of success. We evaluate institutions by the quality of life capacity they preserve and extend, rather than the raw quantity of money they multiply. We return to the great inversion model. The cure requires subjugating the financial parameters. We must force the abstract claims of money back inside the strict physical boundaries of the life ground. Re-embedding credit and digital infrastructure into life-serving parameters allows these technologies to support the living realities they currently dominate. Finance is a human institution. We have the agency to redesign it, transforming it from an engine of extraction back into a circulatory system of trust and repair.